Hello everyone, welcome back to Elect Finance. If I told you that some international funds delivered 74% return in just 1 year, would you believe me? Imagine investing 1 lakh today and becoming 1.74 lakhs in just 12 months. That's the incredible power of global investing when you are pick the right funds. But here is the thing, not all international funds are created equal. Some delivered 76.9% return while others barely hit 5%. Today I am sharing the top 5 international mutual funds that absolutely crushed the market in 2025. This is based on actual data from your investment apps, backed by solid research and designed specially for the 5 to 10 year investment horizon. If you are serious about building wealth beyond Indian market and want to participate in the AI revolution, tech dominance and the precious metal supercycle, this video is for you. So if you haven't already, please like this video, subscribe to Elect Finance and turn on notification so that you never miss our investment insights. Before we just jump into the top 5 funds, let's answer the critical question. Why should you invest in internationally in 2025? Reason 1. The AI and tech mega boom. Here is what most Indian investors don't realize. The world's largest technology companies are not in India. They are in America. Think about companies like nvidia, Apple, Microsoft, Google, Amazon. These aren't just big companies, they are trillion-dollar corporations. nvidia alone has a market cap of 36 crores, approximately $4.3 trillion. That's bigger than the entire Indian stock market. And here is the exciting part. In 2025, these companies are driving the artificial intelligence revolutions. Each tech company globally is investing billions into AI. nvidia created chips specially for AI. Microsoft is the largest backer of ChatGPT. Google launched Gemini AI. Meta is using AI for recommendations. When the entire global tech industry aligns one mega trend, returns become absolutely exceptional. Some of these stocks delivered 40 to 60% returns in 2025 alone. Can you get this kind of exposure in India? Maybe a little through IT talks, but not like this. The concentration of AI talent, innovation and capital is in the United States. Listen to the gold mining supercycle. Now this is something most investors completely miss because they are focused on equities. Gold prices have broken all-time highs in 2025, reaching $3,400 per ounce. That's a 40% increase year to over year. But here is the real opportunities. When you invest in gold mining companies, you don't just get the gold price increase, you get what called operational leverage. Let me explain. If gold prices goes from $3,000 to $3,400, it's a 13% increase. Mining company profits can jump 30 to 50% because of their extraction costs stay relatively fixed. Additionally, and this is crucial, central banks worldwide are buying gold at a record levels. China, Russia, Turkey, India, they all are buying approximately 900 tons in 2025 alone. This is the highest in decades. Why? They are diversifying away from US dollars and creating gold reserves for security. This creates a classic supply-demand imbalance. Supply growing only 1% annually, new discoveries are rare. Demand surging due to central bank buying plus investment demands. Translation: gold mining companies will remain profitable for years. Reason 3. Concentration actually works. Historically, financial advisors have told you diversification is your friend. But in 2025, the data shows something different. Concentrated bets on winning sectors delivered extraordinary returns, while diversified portfolios lagged. Why? Because technology and gold had explosive growth and concentrated funds captured that fully. The Mire NYSE FANG Plus ETF, which focused on just 10 mega tech stocks, delivered 74.1% return in 1 year. Companies thus to the S&P 500 which is much more diversified. It is delivered 24.2% in the same period. The lesson is when the sector is on fire, concentration is equal to higher return. Reason for currency hedge against the rupees. This is a hidden advantage of most investors don't realize. The Indian rupees has been continuously depreciating against the US dollar. In 2000, 1 rupee is equal to $0.025. Now 1 rupee is equal to $0.012. That's a 52% depreciation of the rupee. When you invest in international funds, especially US dollar dominated ones, you are automatically getting a natural hedge against the rupee depreciation. How it's work? Your fund investment growth in 20% in US dollars. Simultaneously, the rupee depreciate 5% against the dollar. Combined effect, your return in rupees become 26% in total. So you are getting a bonus of 6% just from the currency movements. 2025 market context. 2025 is not an ordinary investment year. Here is why it's special. The FANG phenomenon. Facebook, Apple, Netflix, Google, these companies called FANGs or FANG have absolutely dominated the global market. Netflix is up 63.41% in 1 year. Google is up 46.90% in 1 year. Meta, Facebook recovered from the crash and is up 26.57% in 1 year. These are not small speculative stocks. These are the largest companies on the planet, trading on the New York Stock Exchange, and they are still delivering a life-changing returns. Why? Because of artificial intelligence. Every major company bet big on AI. Microsoft invested $69 billion in activation and the largest backer of ChatGPT. NVIDIA created chips that power all AI systems. Apple is integrating AI across all the products. When the entire global technology ecosystem aligns on one massive trend, returns become exceptional. The gold supercycle is real. Gold prices are all-time high. Mining companies' profits are expanding. Central banks are buying the record level. This is in the bubble. It's a structural trend that will last for years. The bottom line. If you missed the initial AI boom in 2023 to 2024, 2025 is offering a second window of opportunity. Same with gold. Many think the bull market is over. It's not. We are in the early to middle stages of a structural supercycle. Here are the top 5 international mutual funds that delivered exceptional returns in 2025. Rank 1. Mire Nasdaq 100 Fund of Fund. 1 year return is 42%, 3 year CAGR is 39.6%, 5 year CAGR is 22.65%. The 10 year CAGR is 22.27. It's the best long term track record. The expense ratio is very reasonable. What you are getting? This fund provides exposure to Nasdaq 100 index. The top 100 non-financial companies on the Nasdaq exchange. It's a passive fund, meaning it's automatically track the index without active stock picking. Top holdings are NVIDIA, Apple, Microsoft, Netflix, Google, plus 95 more technology stocks. Why it crushed the market? Nasdaq 100 is pure technology, and 2025 was the year of technology absolutely dominated. Even single holding benefited from the AI adoption wave. Over 10 years, this fund delivered 22.27% annualized return. That means if you invested 10,000 10 years ago, it would have worth 74,776 today. Rank 2 is Mire NYSE FANG plus ETF fund. 1 year return is 74%. 3 year CAGR is 67.3%. Since inception from the May 2021, it has given a CAGR of 33.24%. Expense ratio is just 0.71%, lowest among top performers. AUM is 2,347 crores. It's growing very rapidly. What you are getting? These funds focus on NYSE FANG plus index, exactly 10 mega tech stocks that have dominated global markets. The top 10 holdings of these funds are CrowdStrike, which is on cybersecurity, nvidia, AI chips, Apple, consumer tech, Microsoft, cloud and AI, Netflix, entertainment, Alphabet, search and ads. ServiceNow is cloud software, Broadcom is a semiconductors, Amazon e-commerce and AWS, Tesla is on electric vehicle. Why this fund has delivered 74% return? This fund owns the exact stocks that benefited most from the AI boom. NVIDIA surged 170% in 2024 and continued strong in 2025. Netflix hit all-time high, Meta recovered 194% in 2023 and another 66% in 2024. Rank 3 is DSP World Gold Mining Overseas Equity Fund. It has 1 year return of 76.9%. 3 years CAGR is 45.7%. Second highest in the 3 years. Expense ratio is 1.64%. It is little bit higher, but the return justifies it. The minimum investment is just 100 rupees. What you are getting? The fund invests in global gold and gold mining ETFs. It is not investing directly in gold bars. It's investing in companies that mine golds. Underlying funds. It invested in BlackRock World Gold Fund, VanEck Global Gold Miners ETF, iShare MSCI Global Gold Miners ETF, VanEck Junior Gold Miners ETF. Why the gold mining exploded 76.9% in 2025? Gold prices hit new all-time highs above $3,400 per ounce in 2025. Here is the game changer for mining companies. When the gold prices increases, mining companies' profit increases disproportionately. The real math is extraction cost for the mining company is 1,235 per ounce, which stays relatively fixed. When the gold prices rises, the profit margin also increases. If the gold price is $3,400, its profit margin is $3,400 minus $1,235, which is equal to $2,165 per ounce profit, which is a 63% margin. Additionally, global mining production only grew in 1% in year-on-year. Demand surging from central banks buying 900 tons in 2025. New discoveries declining in globally. Result: class supply shortage is equal to price stay elevated. Real numbers. Newmont's, world's largest gold miner, produced 3.38 million ounces in H1 2025. The $3,400 per ounce, that's $11.5 billion in gold in just 6 months. All-in cost is $1,235 per ounce, that is equal to 4.2 billion cost. Net profit potential is 7.3 billion in just 6 months. Please note that the risk level is very high. It is commodity price dependent. Rank 4 is Edelweiss US Technology Equity Fund of Fund. 1 year return is 41% and 3 year return is 39.4%. The 5-year CAGR is 19.3%. Expense ratio is 1.51%. It is little bit higher. AUM is 3,598 crores. The minimum investment is just 100 rupees. What you are getting? This fund invests predominantly in 95% in the JP Morgan US technology funds. Unlike the passive Nasdaq 100, it is actively managed. How it works? A fund manager actively selects 50 to 70 US technology stocks based on AI adoption trends, cloud computing growth, digital transformation opportunities, disruptive business models. The top holdings are NVIDIA, Snowflakes, Netflix, Meta, Tesla and plus to 45 plus other technology stocks. Sector breakdown is software is 39.2%, internet is 24% and semiconductors is 90.8%. The top 5 fund is Mire S&P 500 Top 50 ETF Fund of Fund. The 1 year return is 52.4%, 3 year return is 38.5% and the expense ratio is just 0.69%, which is very low. The minimum investment is only 1000 rupees. What you are getting? The fund focus on the top 50 largest companies in the S&P 500, essentially mega cap US companies. Think of it as you have nifty-fifty equivalent of the US market. The top 10 holdings are NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, Tesla, Berkshire Hathaway, JP Morgan Chase. Why still 52.4% return? This fund captures these mega cap companies which benefited hugely from the AI boom. Plus, it includes non-tech leaders like Berkshire Hathaway, which is a stable, diversified company, and JP Morgan Chase's financial stability. The advantage of top 50: lower volatility than pure tech funds, captures 40% of entire MSCI World Index with just 50 stocks. Broader sector exposure, not just on the technology. Mega cap companies have economics, moats, and stability. Still got 52.4% because even stable mega caps like Apple and Microsoft are tech focused and benefited from AI. This fund is best for conservative international investors, first time global investors, those uncomfortable with pure tech concentration. The risk level is high because it's 40% still in the techs. Let me give you a quick comparison so you can see at a glance. I put rank 1 as Meta Asset Nasdaq 100. Its a 1-year return is 42.3% and 3-year return is 39.6%. And the expense ratio is 0.79%. It is best for long-term tech investors. Mira NYSE FANG is 1-year return is 74.1%, 3-year return is 67.3%, and expense ratio is 0.71. Third is DSP Gold Mining. 1-year return is 76.9%, 3-year return is 45.7%, and expense ratio is 1.64%. Good for portfolio diversification. Edelweiss US Tech. 1-year return is 41.1%, and 3-year return is 39.4%, and expense ratio is 1.51%, which is good for active tech management. Mire S&P 500 top 50. Its 1-year return is 52.4%, 3-year return is 38.5%, and expense ratio is 0.69%. It's a conservative global fund. The key takeaway is higher returns comes with higher volatility and risks. There is no free lunch in investing, but the long-term data shows international funds have beaten Indian markets consistently. The critical risk warning. Before you rush in to invest all your savings, let me brutally honest about the risk. The risk one is they are expensive valuations. The Nasdaq 100 is trading at a forward price to earning ratio of 34. The historical average is 28. This means these stocks are expensive. If growth disappoints or earnings fall short of expectations, valuations can compress sharply, causing corrections of 15 to 25%. Risk 2 is currency risk. When the US dollar strengthens against the Indian rupees, your rupee returns get diluted. Conversely, if the rupee strengthens, your return get enhanced. This is a two-way bet on the currency. Risk 3. Geopolitical and trade risk. Trade wars, tariff implications, AI regulations by governments. These can all impact the tech stocks sharply. One bad policy announcement can create corrections. Risk 4 is the concentration risk. The top 5 companies represent 30% of the S&P 500. If this mega company stumble, the entire market correct hard. The risk 5 are they are not guaranteed returns. The 74% and 76.9% return happened in 2025 because of the specific condition. AI boom catalyst, gold supercycle initiation, post-rare cut rally. These conditions won't last forever. You could see 20% corrections in bad years, single-digit returns some years, or even negative returns in the severe downturns. The reality check. When you invest in international funds, you are betting on the US economical strength and tech dominance. The US economy slows or tech stocks fall out of the favor, your returns suffer. My strong recommendations are invest only money if you won't need for 5 to 10 years. Never invest your emergency fund in this. Use SIP to average out volatility. Limit international exposure 10 to 20% of your total equity portfolio. Maintain a diversified portfolio. Don't go all in one any single fund. Remember, high returns require high risk tolerance and long time horizon. If this video helped you understand global investing, please like this video, subscribe to Elect Finance, comment your questions. I will reply to every single one. Share with your friends who want to learn about international investing. What are your questions about international funds? Drop them in the comments. I will create a follow-up video answering them. So let me know if you want a video on any of the topic related to share market or mutual funds.